Welcome back to Investing Talk Podcast.
Today we're looking at Clover Health. The big question is it a good time to buy now?
We want to hear from you. Subscribe, like, and comment to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. Clover Health is, well, it's a really fascinating case in high-growth healthcare tech.
Right. They're in that Medicare Advantage space, aren't they?
Exactly. Squarely in that niche. But the core argument for CLOV, it isn't just about insurance plans. It's really their own tech platform, the Clover Assistant.
Okay, yeah, the Clover Assistant, that's their AI engine, right? This is where the investment case starts to get interesting, different from just a standard insurer.
Totally different.
So what exactly does it do that gives them an edge over, say, a big legacy company?
Well, think of it like real-time, personalized clinical support. It's an AI system. Works right at the point of care.
Point of care. So in the doctor's office.
Precisely. It pushes specific evidence-based recommendations straight to the doctors using it. The critical thing is it's designed for proactive disease management.
Ah, so catching things early.
Exactly, and ultimately for significant cost containment. It's not just managing data, it guides care.
Like flagging high-risk patients.
You got it. Maybe someone who needs an intervention today to prevent a really expensive hospital visit next month. That's the whole model, really. It's built on trying to get data-driven efficiency.
Okay. And the market seems to be buying into the scale part of that story, at least. Looking at the top line, I mean, it's hard to ignore. Trailing 12 months revenue, TPM, hit $1.61 billion.
Which is impressive.
And that's a 34% increase recently. That kind of growth velocity is, well, pretty incredible.
It is. It definitely shows huge user adoption, market penetration, but, and this is the big but for investors. Profitability, yeah. Revenue soaring, but the company's still reporting negative earnings per share. EPS is negative.
Right, and the return on equity?
Rough. It's negative 12.59%. This is why the stock's been kind of stuck, traded sideways for a long time.
Exactly. It raises the question, if the AI is so good at containing costs, why are the financials still showing losses?
That's the skeptic's argument.
Are we just waiting too long for these cost controls to really work? Or is that rapid 34% growth just too expensive?
And that's the critical distinction the sources really highlight. It's sort of the aha moment here. The company is reducing its accounting losses. Year over year, you see improvement.
Okay, so things are getting better operationally.
Right, showing more maturity. But the real structural advantage, the thing setting them apart from just, a cash-burning startup.
What is it?
It's their free cash flow, FCF. They generated positive FCF of $83.15 million.
Okay, let's pause on that. Why is that FCF number so important, especially when EPS is still negative?
Because positive FCF means the company is actually bringing in more cash from its core operations than it's spending.
Right, actual cash.
The negative EPS reflects non-cash stuff like depreciation or maybe stock-based compensation, accounting losses, essentially.
Gotcha.
But the positive cash flow, that shows the business is operationally viable. It's sustainable.
So they can fund their own growth.
Exactly. They can finance that aggressive growth needed for Medicare Advantage expansion without immediately running to issue more stock or take on debt. They have real cash. That resilience, especially next to a fairly modest market cap around $1.94 billion, makes their situation look, well, a lot stronger than just looking at the negative EPS number.
That does change the risk profile quite a bit. It's like they're funding the future with customer money, not just investor cash.
Pretty much.
Okay, so explosive growth, financial resilience. But let's switch gears. Has the market, sentiment started believing this story yet? What do the charts say?
Well, the technicals paint a mixed picture, but a very intriguing one.
Okay.
Short-term view. The stock's trading above its 50-day moving average.
Which is usually a bullish sign. Short-term, momentum building.
Yeah, right. Suggests positive momentum right now. But
there's always a but. The longer-term trend.
Precisely. Still trading below the 200-day moving average. So, yeah, short-term momentum looks good, but the bigger historical picture is still kind of bearish until they really break above that 200-day line.
Okay, but one thing confuses me here. If the fundamental growth is that strong, 34% top line, why is the relative strength index, the RSI, all the way down at 20.48. That seems really low.
That's exactly why this could be such a fascinating entry point, especially for more tactical traders.
Because it oversold.
Massively oversold. An RSI below 30 usually signals that. The market's hammered it probably on those profitability concerns and maybe just broader healthcare volatility.
Okay.
But if you believe the fundamentals are turning, that 20.48 RSI suggests, well, like a coiled spring effect, poised for potentially a strong rebound on any good news.
And is there anything else supporting that idea?
Yeah, the ACT indicator, which looks at momentum shifts. It's also flashing a bullish crossover signal right now.
Okay, so technical signals may be suggesting the market overdid it on the downside. What about recent price action? Where has it been trading?
Locked in a pretty tight range lately over the last 3 months, basically between $3.71 and $3.85.
So that range is kind of the key battleground.
It is. Support, the floor it's been holding, is around $3.50.
And resistance, the ceiling.
Near $4. If some good news hits and it breaks and holds above $4, that could signal a bigger trend reversal. Might trigger some automatic buying, too.
And what are the analysts saying? Do they mirror this sort of cautious optimism?
Yeah, pretty much. The consensus is a moderate buy. The target price range is quite wide, though, from $3.37 up to $4.37.
Yeah, wide range.
And it's worth remembering, back in August, the shares actually traded above the average target price of $3.77 for a bit.
Oh, interesting. So the market had been willing to pay more for this story recently.
Exactly. It suggests that when sentiment is positive, the market sees value here, maybe implying current prices are a bit undervalued compared to those recent highs.
Okay, let's pivot to the timeline then. What are the immediate drivers? What dates should listeners circle on their calendar?
Well, longer term, it's about product evolution. Clover keeps executing there. They just announced their 2026 Medicare Advantage offerings on October 15th.
What was the focus there?
New, affordable PPO plans, that's preferred provider organization, gives members more flexibility. And crucially, they emphasized maintaining stable cost structures.
Stable costs. That's them trying to show the Clover Assistant is working, right? Controlling their medical care ratio, the MCR.
Exactly, demonstrating that control. But the single biggest short-term catalyst, the real acid test for the stock price, it's just weeks away.
The earnings report.
Absolutely. Q3 2025 earnings report, scheduled for November 7th, 2025. Everything we've talked about FCF, that 34% growth, it all gets measured against this report.
And investors won't just want high revenue, right? They need proof on costs.
They need proof of sustained MCR improvement and continued narrowing of that net loss. If they miss on MCR, even with great revenue, those profitability worries will just come roaring back.
Okay, November 7th. Big date. Anything else coming up?
Yeah, a couple things that can move the price, mostly around institutional flows. There's the annual ETF rebalancing on November 18th.
How does that impact things?
Well, depending on how sector ETFs adjust their Clover holdings, it could create some short-term buying or selling pressure, just something to be aware of.
Got it.
And then December 15th, that's when we get the institutional position disclosure.
So we see which big funds bought or sold.
Yep. Reveals how many big players think BlackRock, Vanguard loaded up on CLOV shares heading into the new year. Strong institutional buying would definitely boost confidence.
Okay. So if we zoom out from these near-term things, connect them to the bigger picture, what are the long-term drivers for someone thinking 5 years out?
Long-term growth is really about market expansion, getting into new states.
Right. The Medicare Advantage market itself is huge and growing.
It is, and Clover's just scratched the surface. Also look for strategic alliances, partnerships, and maybe M&A activity.
M&A. That brings us to the speculative buzz. Always add some spice. What's the word on the street?
Well, there's definitely chatter about more AI partnerships. If the Clover Assistant tech can integrate with other big healthcare systems or, get more data, that could scale up their efficiency advantage massively.
And the classic takeover rumor, I assume.
Always persistent with a company like this, legacy insurers must be looking at that 34% growth and that core tech.
As a potential shortcut for themselves.
Could be. Yeah, rumors of acquisition interest from a major established insurer pop up regularly. A successful bid would likely mean a big, quick premium for shareholders.
Okay. But there's another kind of speculation here too, right? The riskier kind.
Yes. We have to talk about the short squeeze potential.
Because the stock has high short interest. Lots of bets against it.
Noted elevated short interest, yeah. So if that November 7th earnings report comes in surprisingly positive, especially if the MCR looks good,
the shorts have to cover. Buy back shares.
They get squeezed. Forced buying to cover their positions. That forced buying plus the already low RSI, it could create a short squeeze that sends the price rocketing up way beyond fundamentals very quickly.
Pure volatility. High risk, high reward.
Absolutely. But it's definitely part of the narrative surrounding the stock right now.
Okay, so let's try to synthesize all this. It's complex. High growth, improving financials but still negative EPS, cash flow resilience, big catalysts coming, high volatility risk. What's the final thesis from the sources?
The overall assessment in the source material is bullish 8-10.
8 out of 10, that's pretty strong.
It is. The sources seem to strongly believe the upside potential really outweighs the current risks, provided management keeps executing.
Okay, let's just quickly recap the three main pillars supporting that bullish view. Connect the tech and the money.
Sure. First, strong revenue growth. That 34.10% TTM shows the product fixed the market in Medicare Advantage. People are signing up.
Pillar 1, growth.
Second, resilient financials. Positive free cash flow is absolutely key here. It validates their operational sustainability, gives them the money to bridge that gap until they hit GAAP profitability.
Pillar 2, resilience via FCF.
And third, the innovative model. That Clover assistant isn't just some add-on, it's their core proprietary tech. It gives them a real sustainable edge in a very cost-sensitive market.
Pillar 3, the tech edge. So, putting it together, this suggests CLOV could be attractive for, well, both types of investors.
Yeah, potentially.
Yeah.
For the short-term tactical trader eyeing that November 7th catalyst, maybe looking for that squeeze or technical bounce.
And for the long-term growth investor.
Just them too, yeah. Banking on those structural tailwinds in U.S. healthcare and Clover carving out its niche with tech.
But listeners need to remember the risks.
Absolutely. Continued negative EPS will definitely spook some investors. And the whole Medicare Advantage sector is always vulnerable to sudden changes in government regulations. That's just a risk you have to accept in this space.
So the ultimate tension here for you listening is really this. Clover Health is making a big bet that its tech, the Clover Assistant, can fundamentally change the game in healthcare cost management. Will that upcoming Q3 earnings report on November 7th finally provide the proof? Proof that their cost control can actually catch up to their phenomenal growth. Because that cost control piece, driven by executing on the tech, that seems to be the only thing standing between today's moderate buy and maybe, just maybe, an unreserved strong buy.